Joining me for a closer look on what's playing itself out in that market scene is a Cobus Potgieter from Southern Cross Capital. Cobus, a pleasure and a good afternoon to you.
Good afternoon, Alexander. Thanks for having me.
Goodness me, Cobus. What a day it's been already. Yeah, red screens all around. Let's talk about it. What are markets battling with today?
The markets are battling with themselves and their own expectations. Came into the office this morning with fewer than 10% of voting districts counted, and be honest, they were mostly rural voting districts, so they weren't even representative of 10% of the vote counted. It looked like the ANC was going to drop to below 41%, and this introduced the proposition of an EFF or an MK alliance, and we saw bonds sell off, we saw the rand sell off, and we saw all the equity indices sell off as well. This against the backdrop, of course, of weakness over our own public holiday in global markets as well. But this was very specifically driven by that sort of expectation, and some models being touted about, projecting that being the end results, which is absolutely preposterous. The fact is we don't know yet, and already things are calming down a bit, and we're seeing the rand coming off those lows. The bonds have added about 10 points already. So it's too early to tell, but the market was perhaps a little too comfortable 3 days ago around that expectation for call it a Goldilocks outcome, where the ANC drops to 46, 47%, and they can cobble together an alliance with the smaller parties, as opposed to that bad scenario where they need a bigger coalition partner, which might upset the apple cart.
I must also ask you just about then what we're also seeing with the rand. If that's on the back of a similar story here, we also know the rand often reacts a lot more to what's happening globally than locally. But is the pull here at home right now?
No, this is very, very South Africa specific.
Sure.
Yes, we did lag, but again, the rand did trade yesterday, right? So we have that information. I mean, foreigners can still buy and sell rands, even though South Africa is closed for the day, and it didn't weaken this much, not at all. I mean, I would say yesterday around what we would consider our close, it was around 1830. So blowing out to 1875 this morning, that's 100%, driven by the election expectations. That's uncertainty around this election outcome ultimately. And I mean, to my mind, they should have made the public holiday today rather. Just in terms of, you'd be quite the fool to be selling, I feel, at 1875, just because that expectation is getting baked in, whilst fewer than 10% of the votes have been counted.
Well, I hope this messaging today in our conversation, Cobus, brings some sobriety to what we're seeing in the markets. They're really starting to look like a bloodbath with a lot of our retailers down. Woolworths is down 7.24%. Now, I want to say that's part of the SA Inc. story, but it could also be very much just a Woolworths story.
Yes, yes. So that one as well. And I mean, perhaps on a day like today, we would expect the market to be more irrational than normal. But Woolworths essentially came out with one of uh, those trading updates that I dislike. So essentially, the JSE has this rule that says that the moment management become aware that headline earnings per share will differ by more than, or earnings per share or headline earnings per share will differ by more than 20% in the next reporting period. They need to come out and say this. But there's another rule that says you need to provide a range of 10% for where that's going to land. So what some companies do is when they become aware, is they release this sort of blunt trading statement, which just says it's gonna be more than 20% deviation. However, we will release a second update at a later stage to provide that range, because we are still in the trading period. It's very difficult to estimate that. So we got that more blunt one, which doesn't provide a range. It's definitely a disappointment, because the market was looking for flat to down maybe 5% from release for this period. So more than 20% is bad. However, they made it clear that it's in clothing, and specifically clothing in South Africa and Australia, without providing guidance on where that impact is. So again, the market is selling off the other clothing retailers off the back of this, without actually having a quantum, without having the clear picture of just how severe the Woolies South Africa clothing business underperformed. So I'm not saying, that that's necessarily wrong. I'm saying that information simply isn't available. So a lot of assumptions being made in that Foschini's, Truers, and Mr. Price, together with Woolies, these four are the worst performing stocks on the JSE today.
Thank you for that, Cobus. I also want to speak to you about Zeda. They also haven't performed their best here in the 6 months leading up to March. They have cited issues with second-hand vehicles or used vehicles, which I'm keen to get your thoughts, considering also how well We Buy Cars is doing. Could it be a Zeda-specific issue here around the used vehicle market?
No, no. Look, I mean, I think they went through a very robust period in the wake of scarcity in the new market, and I mean, we find that the second-hand market used to be quite steady. I know Imperial used to, sort of bank it back in the day, but when the new market became so constrained, and we saw sort of the South Koreans and the Chinese coming in and being able to exploit that situation at the cost of the traditional stalwarts in the South African market, at least, the used market thrived. And it's off the back of that we have actually seen some underperformance in WeBuy Cars as well. We do have a bit of a history there, given the partial ownership that Transaction Capital had in WeBuy Cars before it listed. So it's not Zeta specific. It's difficult to see what the read-through is going to be for WeBuy Cars. Obviously, we're still waiting for that first set of fresh results from them. But ultimately, it's still going to be a cyclical industry. And they do need to experience a pullback, because those prices had become quite elevated relative to new prices because of the scarcity, and that also actually ended up pushing their revenues quite significantly. So it's early days to say we're at the bottom of the cycle, but the market seems to really like the market at the moment. So perhaps we are sort of at the turning point for both those businesses.
Wonderful, Cobus. I want to get your stock pick in a bit, but first, let's talk about, or let's see rather, which accounts your industry peers are liking.
Stock pick is Shopify. They've refocused onto their high income software again. They've sold off their in-house logistics business, and I think they're getting primed to offer great subscription solutions, and will continue to grow in other markets. So I think Shopify would do well, and that's my stock pick.
So we just spoke about the investment holding company trading at a 30% discount to NAV. My stock pick is similar. It's the investment holding company HCI, Oscan Consolidated Investments. It came out with results last week, as well as a bunch of its underlying companies in which it has material stakes. Most of them are listed, the likes of Sorgo Gaming, Southern Sun Hotels, you have Frontier Transport, you have Deneb and eMedia, a few of the smaller players. And if you put all the listed assets together and you add in some unlisted assets, and especially Impact Oil and Gas, which is the big unlisted asset, then I think you get a sum of the parts of 250 Rand a share, trading at 175, so that's a 30% discount. But the key for me here is, what will that net asset value per share do for the next few years? And I do believe it'll grow at an above average rate. Driven by Impact Oil and Gas as they start developing those gas fields, the Venus gas field principally in Namibia. We might get a bit of a bonus with some of the gas fields on the southern coast of South Africa also being developed in the next few years. And then the other assets I like as well. I mean, Sorgo Gaming, it's throwing off a lot of cash. Southern Sun with its Western Cape hotel footprint is well positioned, occupancy is rising. So if you can buy all those nice assets at a 30% discount and you think it's going to grow at a nice rate from one year to the next, why not?
My stock pick tonight is Famous Brands. I think obviously the consumers under pressure, the business not doing well, and you see it in the later set of results. I mean, the business didn't really perform at expectations. But I'll take a bit of a medium-term view. Yeah, I think patience is required for Famous Brands, but I still believe they can grow their revenue in real terms. And there most likely will be some margin expansion as well. Then the margins in all the divisions, franchise, manufacturing, logistics, is below optimal margins. At the same time, they're looking to reduce finance costs as well. So I think if you take a medium-term view, it's quite likely if they can grow their revenue at low double digits, high single digits, they can easily grow earnings low double digits, compounded over the medium term, in my view, and that makes it quite interesting at these levels. But you need economic activity to pick up, and perhaps if there's a positive election outcome and people are looking for SA Inc. stocks, Famous Brands could be a beneficiary of that. And they also need a lot of buying because the liquidity is quite poor in the stock. So one or two asset managers buys into Famous Brands, it could move the needle quite a lot. So yes, I think it's time to look at that one at this stage.
All right, Cobus, keen to get your thoughts on some of those. We have Shopify, HCI, and Famous Brands.
Okay, I love Shopify. If you compare them to Wix per se, they're certainly more e-commerce focused, and it's akin to selling shovels in a gold rush. So we're seeing the digitization of shopping, and these guys essentially allow people like creators on the internet to create their own online stores, and they just sit in the back end, and it's this very, very intuitive, sophisticated platform, software as a service, such a nice business. It is trading on a PE of 60, but it is ramping up significantly. So one should probably be looking at revenue multiples instead of my traditional deep value biases approach. And it has sold off significantly recently. So that's a nice one. I do like Shopify. Again, I'm a deep value guy, so similar to JP, I'm going to like HCI. I have that in my portfolio. I agree with them. It's sitting at a steep discount in excess of 30% to NAV. Plus, you do have that upside in the gas, and that has been swinging the share around a lot of late. But the fact is, there remains a lot of remains plenty of value, and it's nice to and they have a history of doing accretive corporate actions. Famous Brands, a company that has done a bunch of missteps, and again, I've got to talk to my own portfolio. I've been short Famous Brands for a long time. We believe the venture into the UK, the burger business was ill-conceived. There was a bit of balance sheet distressed, and I don't quite see the catalyst for a turnaround yet. They're still very, very exposed to the consumer, to that upper end, and there's some way still to go in terms of fixing it. They're doing some of the right things. They're trying to de-gear that business a bit, but I just don't see a catalyst for a turnaround at this point. And if they continue to shrink earnings, it's not cheap either. So from that perspective, that is not a pick I would go with.
Which pick would you go with this afternoon, Cobus?
So topical, one of those four underperforming stocks. Again, I'm just preaching calm, and the market turned bullish on Mr. Price quite a bit over the last few months. Excellent management team, well executed, quite cheaply priced as well. And off the back of this Woolies update, it seems that Mr. Price is selling off in tandem with Woolies, down just as much. And I think, given the information at hand, that is somewhat preposterous. It is very likely that Woolies is underperforming, in part because of that Australian component, which has been under severe pressure, which has been operating in an almost deflate, a higher, a market where they've started to hike rates again. So, or speaking of hiking rates, the inflation situation there is difficult. They've had cost pressures there, and that might be a significant contributor to this underperformance. And now Mr. Price is selling off as well. So I think there's just this noise around both the election and the Woolies update is perhaps creating a nice cheap entry point for those that have missed out on the initial Mr. Price rally. You can pick it up at a 7% discount to what you could buy it for 2 days ago. So I like Mr. Price at this level.
Brilliant, Cobus. An absolute pleasure having you with us today. I'm glad we could actually speak today. Have a great one. That was your midday markets update with Cobus Potgieter from Southern Cross Capital.